On a quiet Thursday morning, thousands of founders opened their banking apps and felt their stomach drop. Their money wasn't delayed. It wasn't frozen. It was unreachable. Inside Silicon Valley Bank sat the life savings of the tech economy: payroll money, venture capital, runway for survival. By the end of the day, $42 billion were gone, pulled out in the fastest bank run in U.S. history. Startups had 48 hours before missing payroll. Some had 24, some had none. This wasn't a hack, it wasn't fraud. It was a decision made inside a bank that promised safety. And once the first withdrawal started, there was no stopping what came next. Silicon Valley Bank wasn't just another lender, it was the bank of startups. Nearly half of all U.S. venture-backed tech companies kept their money there. Founders trusted it because everyone else did. Investors trusted it because SVB spoke their language. At the center of this world stood CEO Greg Becker, calm, experienced, confident. SVB didn't sell itself as aggressive or risky. It sold itself as stable, a quiet place for smart money. But beneath that calm image, the bank was making one massive bet, and almost no one outside the boardroom understood the risk. During years of cheap money, SVB was drowning in deposits. So it did what many banks do. It locked billions into long-term government bonds. Safe on paper, disastrous in timing. When interest rates began rising, those bonds lost value fast. SVB was sitting on massive, unrealized losses. Greg Becker knew the math. He knew the risk. But as long as clients didn't pull their money, the losses stayed hidden. The system only worked if trust stayed intact. And trust was about to break. In March, SVB made its move. The bank announced it had sold bonds at a loss and needed to raise new capital. To Wall Street, it sounded technical. To startup founders, it sounded like danger. Group chats exploded. Venture capital firms picked up the phone. One message spread faster than any press release: get your money out, now. And once that message hit Slack, the bank was already in trouble. Withdrawals didn't come in lines. They came in clicks. In a single day, customers tried to pull $42 billion. No human system could keep up. SVB didn't fail because it ran out of assets. It failed because it ran out of time. Greg Becker watched as trust evaporated hour by hour. By Friday morning, regulators stepped in. Silicon Valley Bank was shut down. The unthinkable had happened, and the panic was just beginning. The collapse sent shockwaves across the financial system. If SVB could fall this fast, who was next? Founders feared losing everything. Employees feared missing paychecks. Investors feared a domino effect. For a brief moment, the tech economy froze. Then the government made a rare decision. All deposits, even those above the insurance limit, would be protected. The panic stopped, but the damage was already done. SVB didn't collapse because of crime. It collapsed because of concentration, timing, and arrogance. Too many similar clients, too much exposure to one bet, too much confidence that trust would never break. Greg Becker didn't steal money. He underestimated fear. And in modern finance, fear moves faster than regulation. That lesson cost the system billions. Silicon Valley Bank wasn't a fluke. It was a warning, a reminder that even safe institutions can collapse overnight when confidence disappears. In a digital world, bank runs don't happen on sidewalks. They happen on screens. And once they start, no balance sheet can save you. If you want to understand how financial systems really fail and where the next collapse may come from, subscribe. More investigations coming.